It's my pleasure, actually Pavel's pleasure, but he excused that he will not carry introductory talk. Yes, a code. So it's my pleasure to introduce you Saeed Amen, and we are really very happy that he agreed to have a talk here. Actually, Saeed has an experience as a quant from 11 Brothers from Nomura, and currently, it's the most important, he's a managing director and co-founder of the Thalesians, which is a financial think tank. And he and his colleagues, they are, among other things, they are organizing like plenty of talks in London, in New York, which are financial, related to quantitative finance, and they are very interesting. And we were just thinking, I mean, why not to try to introduce Saeed here in Prague, and by actually not to start a tradition of Thalesians talk here in Prague. So hopefully, this is the first talk in the series of talk, which will be in the future. So just stay tuned, and let me just give the place for Saeed to start the talk.
Well, thanks very much. And actually, before I start, I want to say thanks to Jan and Pavel for organising it. So it's basically impossible to organise something remotely. So thank you for taking the time to do that. So yeah, the talk will be split into two parts. So the first part is actually going to be discussing my book, as you can see there, Trading Thalesians, or the ancient world can teach about trading tech. And then at the end, I'm also going to do a live demo with FX data, basically using Python to produce interesting stylistic observations from FX intraday price action. So looking at intraday volatility, also price action around events like ECB and non-farm payrolls as well. So something a bit more, less quantity, and then later on a bit more quantity, and I'll also explain some of my code. So I'm just going to read you the first part of my book. So this was 15th of September 2008. So sleep had failed to rest me. I had lain for hours in my bed, my eyes firmly closed, my mind open. Thoughts whirled uncontrollably through my mind, seizing their chance to hold back the tide of slumber. Rather than attempting to win the battle against my thoughts, I admitted defeat. Deciding it would be more fruitful to leave my bed, my eyes opened, greeted by a new mid-September morning, the light of which had managed to slip through the gap between my curtains. Then emblazoned in red capital letters, I saw a headline that caught my attention. The headline declared that Lehman Brothers had filed for bankruptcy, the company that had given me my first job just over 3 years before that day. So, does anybody remember that day? Okay, I remember that day. Actually, yesterday, Dick Fold, who was the CEO of Lehman Brothers, he actually did his first voluntary public appearance, and apparently it wasn't his fault, so there you go. So what happened next? Well, obviously Lehman Brothers collapsed, so I had a bit of spare time, and so did my friends. With my friends Paul Billicon, he's also an ex-Lehman, but also from Imperial, and Matthew Dixon, we founded the Thalesians as a quant finance meeting group. So in our own very, very little way, we wanted to try to understand what went wrong during the crisis, in a very, very small way. So we had our first meeting in 2009, and we've done over 100 talks in London, New York, San Francisco, Budapest, and now in lovely Prague as well. So hopefully we'll do more with Jan and Pavel's help. So I actually went full-time at the Thalesians in August 2013, publishing independent quant strategy notes and also doing quant consulting. And I also trade my own cash as well. So I'm not one of those people that write stuff and tell you to trade it and then don't actually do it myself. So, but what's in the name of Thalesians? So I had actually worked with somebody called Thales at Lehman. He had told me about Thales of Miletus, who was an ancient Greek philosopher who lived from 624 BC to 546 BC. So Thales, not my friend, although my friend's very smart as well, but Thales, the philosopher, he was a true polymath. He was active in many different fields, so mathematics and astronomy, in finance, also philosophy. And Paul, my friend, actually told me a story about Thales, which Aristotle recounts to us. And in this story, essentially, Aristotle tells us that Thales is mocked for being poor. They're saying, what's the point of doing philosophy? You're going to be poor the rest of your life. It's a waste of time. So Thales, wanting to try and prove them wrong, to prove that he could make money, what he did is he used his intellect to look at the patterns of weather. So he foresaw a great harvest in ancient Greece. So what he did is that he put down a deposit for the use of olive presses during the low season when nobody wanted them. And And then when it was the high season, it was a great olive harvest, and everybody wanted to use olive presses. So then he cashed in his options and made lots of money. But the point is, from the story, Thales didn't necessarily want to make a lot of money. He just wanted to show that he could. So he had a slightly different objective. And he was actually the first person to trade options when you think about it, or future, or forwards, I guess, depending on how you define it. But thinking about it, if we think about his objective was not necessarily to make lots of money, but just to show that he could, it got me thinking maybe there are other ways that the ancient world can teach us about trading today. So is the way to succeed as a trader not necessarily to think purely about making money, but also to have other different goals? For example, looking at your volatility, your Sharpe ratio, your drawdowns. Also looking at how historians in the ancient world looked at history. For example, Herodotus, the father of history. Can we as traders look at our past trading history, look at our backtest to infer something going forwards and to learn from that? And can we think across many different disciplines like Thales did to actually come up with innovative trading ideas? That's another question. And can we understand modern markets through the lens of the ancient world in terms of risk? So here I've just got an outline of some of the book chapters. So we have the introduction, obviously, first of all, that understanding risk in markets, the difference between alpha and beta, reducing the risk. Also, what about targeting other objectives as opposed to purely returns? Then the black swan and the windows of doom. So I'll explain what the window of doom is later on. Okay, so I'm just going to use the data that I cached from earlier. So I hope that's
today's data, right?
Yeah, it's today's day trading. So it'll just have to be a half an hour of data, which isn't how. So what it's going to do is it's going to load up some intraday data. So we can see that here. So here basically it's got the price action for euro, dollar, yen, and cable historically. And then it's going to plot today's data as well. Okay, so you can see that this is in GMT time. So we've got nearly all today's data. This is just the past half an hour. That's not there on that. So now we're going to actually do something a bit more interesting than actually just plotting the data. We're going to actually look at the intraday volatility patterns in FX. So here what you see is you see the intraday volatility pattern for euro, dollar, for dollar, yen, and for cable as well. So you've got interesting dynamics, and this is actually in London time. So you have a big spike in cable volatility, so basically sterling against dollar at 9:30, but you don't have any other crosses. So has anybody got a good idea why you have a spike in sterling but not any other crosses? I can tell you if they
News?
Yeah, news, yeah. So there's generally tends to be UK data around 9:30, so you can see it picked up there. And you have a big spike here at 1:30 London time, which is when you get US data. So all the dollar crosses will be more volatile. And you also see this general pattern of there being lower volatility during Asian hours. It picks up when London comes in. When New York comes in, you see a further uptick of that. And when actually London goes home, it goes down again. So you get most volatility actually in that area where London and New York are coming in. And you also get a bit of a spike at 3 p.m, which is when you get more US data, and also at 4 p.m. as well, which is when you have the WMR fixing for FX. Okay, so we've looked at rolling volatility. The next thing we're going to do is comparing volatility to tick count. So here we're going to look at it just for Eurodollar, and this is over the past year only. So tick count is basically how many times the brokers refresh their prices in a certain time. So you can see that on the right-hand axis there, and on the left-hand axis you've got volatility. And you can use tick count as a proxy for volume as well. So if there's more ticks, it tends to be the case if you have more volume going through the market. So what you notice is, for example, at 1:30, when we had US time, when we had US data releases, you have a big uptick in volatility, but you also have a lot of uptick in the tick count as well. So there's more volume going through, but you also have a lot of volatility there. So typically that means that you don't have as much liquidity at that time because there's more risk going in, but the volume is also picking up. So if you see something at 4 p.m., you have something very different. You have a bit of an uptick in volatility, but you have a lot of tick count there. So for the increase in volatility, the amount of volume that's going through is actually considerably more. So you could argue that there's more liquidity at that point than there is at 1:30. And I think say that's fairly intuitive because 4 p.m. is actually the fixing, where you have a lot of two-way price action. Whilst at say 1:30, it's not going to be two-way the price action. It's going to be all one way. So if a US data release comes in better than expected, then everyone will be buying dollars. Conversely, everyone will be selling dollars from that perspective. So you can use the metric of looking at volatility to tick count or volume as a proxy for basically liquidity in the market. So I think also if you were to look at, say, bid-ask spreads, they'll probably show you something, I don't know whether it'll be exactly like this, but it would be interesting to compare bid-ask spread around 1:30 and also 4 p.m. when you get the fixing. Okay. Now we're going to actually delve into looking at price action around the US employment report. So that's on the first Friday of every month at 1:30 London time. And you can see here I've got a calendar of all events. I've got future events as well. So I haven't got any prices for 2016, unfortunately. I'd love to, but I don't have any prices for that. So all we're going to do here is we're going to plot what happens to euro dollar during the US employment report. So I know it looks slightly messy, but the idea is to look historically what's happened to euro dollar basically in the 3 hours after the US employment report. So if you look in orange, that's the average. So on average, nothing happens, which is actually quite interesting, I'd say. And then in red, you actually have what happened in the last payrolls in euro dollar. But I think kind of as a more interesting point, it gives you bounds for where you think price action will actually be. So if the price is more than 1% or less than 1%, that's quite unusual actually. So it can give you an idea where you might want to put your stops around price action and the like. Okay. And then it's going to put up something looking at surprises as well. Oh, sorry, intraday volatility. Sorry, I was mistaken. So here we're looking not so much which direction is euro dollar going, but where does the volatility actually pick up and go down in non-farm payrolls. And you can see that the 5-minute volatility actually gets very high, it's around 250% when you have the payroll coming out. But it actually dissipates very, very quickly after that. So in orange, you've got the average volatility throughout the period. So you can actually see that after about, say 2-3 hours, the volatility actually goes down from where it was initially.